Well, hello. Welcome, everyone, to the final day of the Definiti Retirement Academy for 2022. Congratulations, you've made it all the way through the week. Thank you so much for attending today. Just like last couple of days, we've got another good session planned for today. Just to recap, over the last few days, we've had sessions on the basic 401k. We call that the 401k 101. Kind of giving you a basic structure and understanding of the definitions and the structure of a 401k and who to ask what. And then we've also talked about Plan Sponsor Link and told you a little bit about that. And all of this happening in the Plan Sponsor track where you are now. Now, I've said before, but I just want to say again, right next door, the advisors are all in the advisor track. And they're hearing from our plans, from our sponsor partners on topics that will help them serve you better. So we're really excited that you're here today. And mentioning our sponsors, I do want to take a quick moment to say thank you to each of them, because without their support, it would be difficult for us to put on this Retirement Academy for you. So special thanks to John Hancock, to American Funds, Securian, Principal, Voya, PenChecks, Empower, Transamerica, Lincoln Financial, T. Rowe Price, The Standard, and Vanguard. Again, without them, I hate to think about it. It's just been a lot of fun for them to participate in the advisor track and support us in this effort. A couple of housekeeping notes, things to think about, to keep in mind while you're watching today's sessions. We will be taking questions during the session. In fact, the last session today is called the study hall, and that's all it's going to be. Frequently asked questions that have been asked this last week. And we're really going to put our DB and DC admin team to the task and see if we can get some really great answers for you in that session. So use the chat function if you have a question, and I will be sure to give that to our speaker and get you some answers. The other thing that I want to let you know is all of these sessions, both Plan Sponsor Track and Advisor Track, are being recorded and will be posted to the website for Definiti next week. You will get an email when those videos are posted. And then during each session, we've talked about some additional resources that you might find helpful. Those will also be posted on that video as well. So not only will you be able to find a link for a session that you missed or one that you want to watch again, but you'll also have a link to any of those resources that we mentioned in that session. So with all of that said and done, I think I've covered all of the need to talk about. Let's transition and move into our first session for today, and that's Julie Goodwin. Julie, the floor is yours.
Okay, great. Thank you, Elke. What I'm going to cover today is options when you fail a test, and all retirement plans are subject to compliance testing. It's part of the reason that firms hire a TPA, because we study the regulations, we work in them every day, and it's our job to help you have a successful plan. So we're going to move right ahead into the next slide, and I am going to share my own screen so that I can advance things along here. Okay, so what we're looking at here, the very first thing, you should be able to see the annual compliance testing. What it is, all qualified retirement plans are subject to certain IRS mandated tests each year called non-discrimination tests. The purpose of these tests is to ensure that all the plan benefit is for everyone in the company, not just the owners, not just the key employees, not just the HCEs. The most common tests that plan sponsors have issues with are the top-heavy test and the ADP or ACP test. A plan can't remain in a failed status. A correction method is required each year, and there's multiple ways to correct each of the tests. Some of them get a free pass. Some of them may not apply depending on the contribution types. In general, there's limits testing, and I just wanted to point out two things. No matter how your plan is set up, whether it has salary deferrals or not, whether it has employer money or not, there are contribution limits to what can go into a plan. These limits apply to all participants in the plan, regardless of their designation as an HCE, highly compensated, or a non-highly compensated employee, or if they're considered key. And we'll go over those definitions in just a minute. If your plan has salary deferrals, the first general test that would apply is a deferral limit. And this is an individual employee deferral limit. It's measured on a calendar year basis, and it's established by the IRS. For 2023, the deferral limit is $22,500 if you're over the age 50 by December 31st of that year. If you are over age 50, you're allowed, I'm sorry, let me correct that. It's $22,500 if you are under age 50. It is over age 50 that you're allowed for catch-up, which is the additional $7,500 for a total of $30,000. Again, this is an individual basis, and it's one limit regardless of the number of plans a participant would participate in. So if you have an employee that participates in two plans because they work for two different organizations, they still only have one limit. If you know of an employee that may work for two companies and participate in two plans, it is the employee responsibility to monitor this, but they may need your assistance. If they do end up going over it, it does need to be corrected. The other limit is an annual addition limit, and this would apply to all contributions within a plan. And for 2023, the annual addition limit is equal to the lesser of 100% of compensation, or $66,000, not including catch-up contributions. In the event that there are excess contributions, refunds, if their salary deferrals, must occur by April 15th to avoid negative tax consequences for a participant. Now, one of the things that you may wonder is, if an employee has a low salary, or how would this affect an employee? For example, say you have an employee who only makes $22,000 a year, and this is a side job for them. They could choose to defer 100% of their compensation. If your plan also has employer contributions, that employer contribution could push them over this limit of the $415. The refund would come back on the salary deferrals, and that would be based on how the plan is set up. So that's just something to keep in mind. It doesn't happen very often because employees with lower salaries generally don't contribute a high amount, but it is possible. So here's an example. Frank's 45, he participates in your 401k plan. He chooses to defer the maximum contributions to the plan. Your plan is set up as a safe harbor non-elective. That means it has a required 3% contribution. It also has a stated 10% profit sharing contribution. If Frank only makes $21,000 in 2022, his contributions would be as follows. He defers 100% of his compensation. He gets 10% profit sharing, and he also is required to get the $630 as safe harbor. His total contributions for 2022 would exceed his compensation. He has an excess. Both the profit sharing and the safe harbor in this example are stated contributions, and they are required by the plan. That means that he would be required to get a refund of $27.30 of his salary deferrals. Highly compensated employees. The majority of all tests in a plan compare benefits provided to highly compensated employees to those that are non-highly compensated. A highly compensated employee is someone who is more than a 5% owner at any time during the current plan year or the look-back year. This definition also includes what is considered family attribution. And so if I own 100% of a company, and my spouse also works there, he is considered to own 100%. So this would be the same as my children or my parents. Another way that a person becomes highly compensated would be is if they earn over a certain dollar amount in the prior year. For example, if an employee earns $135,000 in 2022, they would be an HCE in 2023. If an employee earns $150,000 in 2023, they would be an HCE in 2024. The limits for HCEs and contributions are set each year by the IRS. They generally increase for cost of living, and they're usually announced mid to late October, early November. If an employee does not meet the above qualifications, then they're considered non-highly. And this will come into play in all of your testing for non-discrimination purposes. So there's two things that come into play looking at your testing. And the first one is, do you cover enough employees with that contribution type? And is the amount of money or contributions being allocated non-discriminatory between your two classifications? When I say each contribution type, plans generally allow for 3 different contribution types, or they can allow for 3 different contribution types. There is what's called the 401k, and this makes up pre-tax deferrals, Roth deferrals, and it would be what's reported on the W-2 in box 12. The other component that can be in a plan is optional, and it's considered 401m, and this is any kind of matching contributions. Safe harbor match, discretionary match, fixed match. If a plan would allow post-tax contributions by employees, they would fall under this option as well. The third item then is considered a 401a or non-elective, and this is your profit sharing, money purchase type of money, or your safe harbor non-elective. Anything that's not based on whether or not your employees defer is considered non-elective. It's not based on an election. When it comes to each of your testing, you're always going to have to pass both parts for every contribution type, coverage and non-discrimination. When it comes to coverage testing, it is allowable to exclude specific groups of employees from participating in your plan. This comes up a lot when employees talk about, or plan sponsors talk about, well, we have part-time employees, or maybe we have employees that are paid commission only. Excluding an employee does not necessarily exclude them from being counted in the coverage test. And an excluded employee is different than an employee who elects to not defer into a plan. You should not confuse not eligible for benefits within your other benefit plans, such as health insurance, paid time off, with not eligible for the retirement plan. Eligibility in a retirement plan is governed by the plan document only. So, for example, it's not common to have your benefit plans set up to where only employees that work more than 30 hours a week are eligible for healthcare, or are eligible for with FSA, or your paid time off, or your vacation. Those requirements and those restrictions do not apply to the retirement plan. Anybody that works for your organization would be considered and reviewed for eligibility in the plan, regardless of these other requirements for a benefit plan. If you would fail a coverage test, you have options to correct. And you have to correct. You can't just kind of throw up your hands and say, I'm sorry, we don't pass coverage this year. It is what it is. You do have to correct it. So one of the ways that you correct a failed coverage test is that you provide contributions to your employees that may have been excluded. And the other option would be to give higher contributions to employees that weren't excluded, but maybe weren't getting quite as much money. Both of them can be costly because they require additional contributions by the employer. So an example that would lead to a coverage issue would be if your plan imposes a last day or a minimum service requirement to receive a profit sharing allocation. Maybe the majority of your people never work a full 1,000 hours. Those people would still be counted, but they would average into your testing as a 0. And anybody that works in averages realizes that when you have a 0 averaged in, it greatly lowers your your percentages. An example of excluding employees that would not exclude them from being counted in a coverage test would be if you have hourly employees when you're excluding all your hourly employees and only wanting to provide a plan for your salary employees, and all your hourly employees are not highly compensated. That would also cause a problem. The ACP test, actual deferral percentage and actual contribution percentage, compare the averages of these contribution types for the HCEs to that of the non-highly compensated employees. For example, if you have two highly compensated employees and their deferral rate, when calculated on an annual basis, is 5%. You would do the same calculation, or we do the same calculation for you, averaging what your non-highlies defer, and we compare the two. You're allowed a discrepancy, but at the same time, it can't be too great. So what happens when you fail these tests? The first thing that happens automatically is that excess deferrals that can be recharacterized as catch-up are recharacterized. Sometimes this can avoid refunds altogether. Unfortunately, it doesn't always happen. The next option is to refund your contributions to your HCEs. These refunds must be completed before March 15th, or the employer, not the employee, is subject to an excise tax of 10% of the excess contributions. This is one of the reasons when census requests go out that we ask for them to come back sooner rather than later, because if your plan is subject to this test, then we have to have the time to process it. The other option is to allocate an employer contribution to eligible non-highlies to bring their average into a passing range. This is called a QNEC, qualified non-elective contribution. It comes out of the employer's pocket. It is 100% vested. And again, it can get expensive. Another option that was just passed in the last couple of years under the Secure Act is that you can retroactively adopt what is a safe harbor non-elective provision. And this would be that everybody in the year being tested automatically gets 4% of their eligible contribution, and you get a free pass. Everybody is happy and no one's getting a refund. These employees are getting an extra contribution and the plan moves on. Some items that are proactive as an approach, those would have been reactive after a failed test has occurred, would be you could limit the deferral rates of your HCEs. This can result in your HCEs not maximizing out on their contributions. If the average of the HCE contributions can only be 5% and you have two, but one of them doesn't defer, the other person could have technically deferred 10%. Divided by 2, you're still at 5%. But you don't necessarily know that in advance, depending on how your testing is set up. It can still result in a testing failure, and you can lose good employees. A lot of employees now are asking about retirement plans, and they're wanting to know if they can contribute, if you have matched, things of that nature. Hiring somebody and then being highly compensated and then telling them that they can't participate in your retirement plan could be an issue. You can change how you determine who your HCEs are to an extent. This is usually only beneficial if you have a lot of HCEs that are non-owners, because part of the process would be for you to allow them to be considered non-highly, and they would raise the average of your non-highlies. Again, this can still result in a testing failure. The other thing that you can do is to adopt a safe harbor non-elective or safe harbor match provision that would be contributed each year. The contributions are 100% vested, but they give you a free pass when it comes to these two tests. Key employees and top-heavy testing. This is another test that comes up each year that has to be run for your plan. And what it does is the top-heavy test will compare contributions, account values at the end of the year for those that are considered key to everybody else. So who are your key employees? Key employees are officers with an annual salary greater than $215,000 for 2023. That makes them key in 2024. Again, that dollar limit is based on the cost of living and issued by the IRS each year. Another provision that puts somebody into a key employee position is somebody that owns more than 5% of the company. And again, your family attributions would apply. And the third thing would be an employee that has more than 1% ownership and an annual salary greater than $150,000. In this example, that dollar limit does not change. It stays constant regardless of cost of living adjustments. The test itself, as I mentioned, compares the total account value of key employees to the total account value of all the participants in the plan. The plan is top heavy if more than 60% of the total balances are owned by the key employees. Plans with fewer participants, small plans, are more likely to be top heavy because you may have a small family run company that is owned by mom and dad. Maybe, the 2 kids work there, and maybe you only have 3 other employees. If the owners and family members, the key employees, are contributing at higher rates, the plan is more likely to be top heavy. A plan's potential to be top heavy should always be considered when removing a safe harbor plan, a provision from an existing plan, or choosing to not add one to a 401k plan. So when you're looking at your plan design, and especially in this economy where things are kind of rocky, you may have a safe harbor plan. Maybe you're considering removing that safe harbor provision because you have lowered your salary deferrals and you don't have to worry about the ADP ACP test, and you could save some money by not providing this benefit. A 401k plan that does not have a safe harbor provision and it includes only salary deferrals can still be top heavy, and an employer contribution can still be required. And so I'll give some examples and some additional information here. When a plan is top heavy, the correction method is an employer must provide a minimum contribution to all non-key employees. This contribution is equal to the lesser of 3% of compensation or what the highest key employee contribution percentage is. So in that description and in that definition, if the highest total contribution percent for any one key employee exceeds 3%, non-key employees must receive at least 3%. If the key employee percent is only 1.5%, then that drops to 1.5%. The good news for a top-heavy contribution is that all employer contributions made to a plan count towards that minimum contribution limit. So if your plan is already providing a safe harbor match or even a non-safe harbor match, those matching contributions do count towards the top-heavy minimum if your plan is top-heavy. Some exemptions from top-heavy funding are safe harbor plans. And if the only contributions being allocated to a plan for the plan year are those that meet safe harbor provisions, then the plan is not required to provide a top-heavy minimum contribution. So for example, if I have a safe harbor plan with any allocation of non-matching employer contributions, example, profit sharing, this would require minimum funding if it's top-heavy. So if the plan is salary deferral and I have a safe harbor non-elective 3%, and those are the only 2 contributions in the plan, there is no top-heavy funding required, even if the plan is top-heavy. Likewise, if it's a safe harbor plan that uses the matching provision, if the only contributions are the salary deferrals and the safe harbor match, minimum funding would not be required in the event the plan is top-heavy. If, in those same examples, the plan sponsor decides to contribute any kind of discretionary money, profit sharing, even if that profit sharing allocation is only 1%, the top-heavy minimum would apply, and the percent that would be required would be based on the total contribution to the highest key employee. So that would mean it would include a key employee's salary deferrals, any safe harbor, and what they received as profit sharing. And that's how you would how you would determine the amount that's required. Some additional notes on top-heavy. If your plan does not include a safe harbor non-elective or safe harbor match, but is top-heavy, the required top-heavy contribution does not provide the same exemption from the ADP test as a safe harbor contribution made for top-heavy funding. So for example, you have a salary deferral only 401k plan. You don't want to do safe harbor. You're fine with the testing. You're fine with having to get a refund. And the refund is okay, and we can talk about that in a second. If the plan is top-heavy, your options would be, you would be required to provide the 3% top-heavy minimum, if that is the, I guess, allocation rate of a key employee. That 3% that you're providing for top-heavy minimum would not give you the same automatic pass and avoid your refunds for the ADP test. That's why a safe harbor non-elective plan is one of the most common setups for a small plan, is because the safe harbor non-elective or a safe harbor match, they do a double duty when it comes to passing the test. If your plan is a 401k plan and it is top-heavy and it's failing, you would still have to provide the refunds or provide the non-elective contribution, which may or may not be just as expensive as the safe harbor contribution. So that is kind of circular. It comes up with smaller plans more than bigger plans, just because fewer people to kind of make up that balance. The other part that comes up often has to do with key employees and family attribution. And so a top-heavy plan consisting solely of employee deferrals for the year is still subject to that minimum contribution if any key employee contributes to the plan. An example of this would be, I own 100% of the company. I know that we're top-heavy. I'm not going to defer. There are no other contributions, just deferrals. My daughter also works at this company and she's just starting out, and I have encouraged her that she should be contributing to her retirement now so that she can retire early. The top-heavy status of the plan and her contributions would require a top-heavy minimum contribution made by the employer. So it's important to know who your family members are and how that attribution works. Ask your plan consultant. There's going to be some additional information, that we do hand out and provide to you. But some of the biggest things that you can do is just ask. Even though something sounds like a really good idea, getting rid of a safe harbor or not adding one because you want to save money, you're just going to defer. Just because you can do that doesn't mean that it may work for you. So you want to have those conversations in advance versus after, because once the plan is in a top-heavy status or in a failed testing status, you do have to take action to correct. You can't just say, I'll just undo all the contributions I made for this year, or we don't really want to do this anymore. We're just going to kind of shut it down and be done with it. You have to correct it under an approved method before you can move forward. Top-heavy status is the one status that carries over from year to year, and so it will. What happens in 2022 as of 12/31/2022 will decide what has to happen in 2023. Your plan can go from being top-heavy to not top-heavy, and that is, based on maybe some of the key employees leaving and taking their account balances with them, or maybe you're hiring more people and your other participants are contributing it at higher rates. Last that I just wanted to touch on, that's really not a testing related item, but something else to consider when you're looking at your plan, is audit requirements. There is an act, it requires an annual audit of plans, financial statements each year by a CPA, and this applies to plans that have 100 or more eligible participants at the beginning of the plan year. Plans meeting this criteria are considered a large plan. So for example, if you have 100 employees, 130 employees, and you implement a 401k plan and you make it effective on January 1, 2023, and you decide to waive the eligibility requirement just for this one time because you're starting up the plan and you want your employees to participate, you would, with 130 employees, immediately be required and subject to an audit for that very first year. Now, there is a provision that does allow you to avoid the audit and to work back out of an audit status, and that's called the 80-120 rule. And what this is that if you are an existing plan and you've been below 100 participants, but you happen to go over that number on the first of any given year, you actually have to get all the way up to 120 before the audit is required. Once you're in audit status, you have to get down to less than 80 participants on the first day of a year to get out of the audit. And this audit is not, this is not the DOL coming in and doing an audit. This is not the IRS coming in and doing an audit. This is a voluntary or voluntold audit by a CPA each year. When it comes to counting your participants, the participant count includes all current employees who are eligible to participate regardless of their election to do so, along with any terminated employees who still have an account balance. So maybe at one time you had 130 employees and you were subject to an audit because they were all participating, and you have now downsized. Those participants who may no longer be employed but still have a balance in your plan count towards your participant count each year. It's one of the reasons that we encourage you to be proactive in encouraging your terminated participants to roll their assets out of the plan. There are provisions within the document that allow you to automatically have participants with small balances forced out of your plan. We would recommend that you provide your terminated participants with a letter upon termination or with their last pay stub that says, hey, you know, you're no longer employed by us. We believe you have a balance in the plan. Here's the contact information for you to elect a distribution from the vendor. If you have questions, you know, contact us. You always want to be proactive. Once a participant is lost, it's really hard to find them and it can be expensive. And that is everything that I had. It was a lot of information, a little more technical than maybe expected, but it's information, even if you don't understand all of it or grasp all of it, to just know that these things are out there. And when your RPC and your testing team comes to you and says, hey, we have a problem with coverage, at least you have a little bit of an idea of what coverage entails, or we have a problem with this ADP test, or your plan is top heavy. You know, here are some things that we need to look at doing.
Yeah, that's fantastic, Julie. I'm really glad that you gave this presentation. We talked a little bit about audits yesterday and even some testing. So this was great, deep dive into some of the solutions that are available. I don't yet have any questions from the audience, but I did have a question. I had a question. I'm just curious, as you're going through testing and when you're working with plan sponsors and you're doing that, what do you think is the most common question about testing? What question do you get most often from plan sponsors about testing?
Sure. So I think that the number one question that I think that I get when I'm working on a project for a client and doing their testing is, why is that person an HCE? That they're not an HCE, they only make $40,000. Or why do I have to give this person who is an HCE 3% contribution? I already pay them enough money. I think those are probably the two biggest questions that come up, and knowing it's complicated. You know, I don't think that the IRS does anything that's really easy on the surface, but I think that those are the biggest questions, and they can change from year to year. So the sooner we get information, the sooner we can help.
Yes, you've reiterated several things that we've talked about this week. One is to be in touch with your retirement plan consultant often. Let them know early what's going on with your organization, if you're adding employees, if you need to make a change, so that we can help you walk through each of these scenarios. You can see that Julie's kind of illustrated situations where if we know in advance, we can help you kind of avoid some of the pitfalls that you might run into. That's why we're here. We're here to help you work through those processes. So, Julie, thank you so much for this review. It was really helpful. As far as available resources, we have obviously the session replay, and I mentioned earlier that that will be available next week, so be watching for that. And then also a document on those non-discrimination testing, kind of describing it a little bit more often. That's something that not only is available, will be available on the website, but then it's also something that you might get if and when your plan is tested and you have additional questions. It's another resource that's available for you as well. So just kind of going through those things, just kind of wanted to pause a second and see if there are any other questions. And no, Julie, it doesn't look as though we've got any additional questions for you today, but man, I really appreciate you providing all of that detail. It was really great. So thank you so much for that today.
Thanks, Elke.
Thanks, Julie.